Well, there is, of course, in the Netherlands, banks are looking into their balance sheets, and under pressure of the Dutch National Bank, they are now more or less restructuring their balance sheets, and actually the allocation of capital towards real estate investments and debt financing of that is actually a non-brainer in the Netherlands at present. And that is also hitting, as such, let's say, the willingness to invest in property by Dutch investors, and also investors from abroad heavily, in the negative sense of the word. And that is, well, from Basel III point of view, it's fully to be understood when you look into, let's say, the financial situation of Dutch banks as such. On the other hand, when you look into, let's say, the personal savings of Dutch households and also their pension savings through pension funds, we are talking about, let's say, 400 billion euros of personal savings via banks, and about 1,000 billion euros in pension funds as such, of which the vast majority is invested outside the Benelux and outside the Netherlands. And that is a major debate behind the scenes where, let's say, the public and also the government and parliament is actually saying, well, that's strange. That Dutch pension funds and insurance companies, but mainly pension funds, are looking for the higher returns, but therefore also the higher risk somewhere abroad in the US, in Asia, in China, in Australia. And they are more or less ignoring, let's say, the stable risk-return ratio in the Benelux and in the Benelux area as such, and in the Netherlands in particular. So what we now see is a refocusing of Dutch pension funds under that public pressure into the local and regional area, understanding, let's say, risk a bit more, being supported by government, and then what I hear and see is also that they are looking into what we might call more the alternative sectors of the real estate sector, and then we are talking about infrastructure on the one hand and residential.